I want to begin with something a little uncomfortable, something that cuts sharply through the noise that most people mistake for insight. Investors don't know what we're in. They think they do. They think they can feel it, measure it, chart it, label it, and map it against history like some neat template that always worked before. But they're wrong, and they don't know they're wrong, which is always the most dangerous kind of wrong. They've mistaken the fog for the landscape, the narrative for the data, and the moment for the cycle. And because they believe the story they've been telling themselves, they've become blind to the one that is unfolding in front of them. I say this not to be dramatic, but because I believe clarity begins with the recognition of ignorance. And right now, the market, this thing that so many pretend to understand, has quietly entered a phase that very few are equipped to navigate. What follows is not a prediction, not a prophecy, not a declaration of certainty, but an analytical exploration of signals that investors are ignoring. It is a diagnosis of a condition that continues to grow more severe while being camouflaged beneath the comforting appearance of normalcy. When I look at the markets today, I don't see optimism or resilience or a new era of innovation. I see a frame, a structure built on assumptions that were never tested under real stress. I see the lingering effects of a decade where capital was priced incorrectly, risk was anesthetized, and investors were conditioned to believe that downturns were brief inconveniences rather than natural outcomes of excess. The shock therapy of recent years, abrupt rate changes, inflation surges, liquidity withdrawals, did not reset the market. It destabilized it. Imagine a structure designed for a calm climate suddenly subjected to a violent storm. The beams flex, the joints loosen, the angles shift. At first it stands, appearing unimpressed by the weather. But inside, the stress accumulates, metal fatigues, wood warps, bolts loosen 0.5 millimeter at a time. From the outside, nothing looks wrong, but internally the integrity has been compromised. That's the market today. Superficially intact, internally strained. I keep hearing the same refrain repeated by analysts who should know better. The consumer is strong, employment is solid, corporate earnings are resilient, and technological innovation will accelerate productivity in a way that justifies lofty valuations. But when I drill into the numbers, really drill into them, I see something very different. I see a consumer who has been maintaining the appearance of strength through debt expansion, not income growth. I see employment figures inflated by part-time jobs compensating for the loss of full-time positions. I see corporate earnings that have been massaged by buybacks, accounting adjustments, and one-time cost shifting. And I see technological innovation priced as if it were guaranteed, universal, and immediately transformative. Markets have always been vulnerable to narratives, but rarely have they been so dependent on them. There is a concept in statistics called lagging indicators. They tell you what has already happened, not what will happen. But right now, investors are treating lagging indicators as forward signals. They're looking at data that reflects yesterday's reality and using it to justify tomorrow's decisions. Forward-looking indicators, the ones that actually predict T-movement, are flashing in a direction that contradicts the comforting narrative. Manufacturing new orders are deteriorating, small business credit conditions are tightening, delinquency rates are rising, profit margins are compressing, and liquidity is quietly evaporating from areas that once depended on abundant, low-cost capital. These are not speculative interpretations. They are measurable shifts occurring underneath the surface, while headlines remain focused on superficial milestones like index highs or short-term earnings beats. One thing that investors consistently misunderstand is how slow-moving systems collapse. They don't collapse at the moment the stress is applied. They collapse when the accumulated stress exceeds the threshold that the structure can tolerate. It's like watching a glacier crack. At first, the fissures appear so slowly you barely notice them. Days go by, weeks pass, and the ice still stands. But inside the glacier, pressure is redistributing, channels are widening, and the structure is weakening. Then one day the entire sheet fractures in what looks like a sudden event, but it was never sudden. The breaking point was merely the final step in a long silent process. Markets work the same way. The breaking point always appears sudden to those who weren't paying attention to the slow changes that preceded it. Right now, the slow changes are everywhere. Investors have grown accustomed to a market environment shaped by historically low interest rates. Low rates became the air everyone breathed. They lifted valuations, subsidized leverage, and justified speculative behavior under the illusion of safety. But when rates rise, valuations must contract. There is no way around that. Every asset is priced relative to the cost of capital. Raise the cost of capital, and the theoretical value of every future cash flow declines. This isn't pessimism, it's mathematics. And yet investors continue to behave as if the laws of financial gravity have been temporarily suspended. They cling to the idea that the worst is behind us simply because discomfort has become familiar. But familiarity is not stability. Pain does not automatically indicate progress. Investors misunderstand the current market environment because they're relying on frameworks built for a world that no longer exists. They look at the market and see stability, but what there are. Ely seeing is the residue of a decade-long regime where money was cheap, liquidity was abundant, and every dip was followed by an engineered rescue. They mistake that memory for a constant. It's as if they've been staring at a painting for so long that they can no longer see the cracks forming beneath the surface. The frame looks the same, the colors look familiar, and the subject hasn't shifted, so they assume the painting itself is unchanged. But it's deteriorating, slowly, quietly, and the deterioration is happening in places most investors never bother to examine. The primary reason for the misunderstanding is that investors have become conditioned to treat the past as the blueprint for the future. They look at charts, cycles, and historical averages as if the underlying conditions that produce those patterns are still intact. They're not. A market shaped by artificially suppressed interest rates cannot be analyzed with the same tools used in a market where rates normalize or fluctuate violently. Yet many investors cling to those outdated tools because they offer psychological comfort. They want predictability, even if it's an illusion. The models they use, the assumptions they make, and the narratives they repeat are calibrated to a regime that ended the moment capital regained a price. Another layer of misunderstanding comes from the misuse of data. Investors prefer data that confirms what they want to believe. They gravitate toward lagging indicators because lagging indicators create neat, stable stories. Strong employment, solid consumer spending, impressive corporate earnings, numbers that look reassuring on the surface. But those numbers reflect decisions made months ago, sometimes a year ago. They are echoes, not forecasts. Meanwhile, the forward indicators, the ones that whisper instead of shout, tell a very different story. Credit is tightening. Delinquencies are rising. Corporate margins are thinning. These aren't dramatic events. They're the early vibrations before the structural shift becomes obvious. But because they don't fit the optimistic narrative, investors dismiss them as noise. There is also a psychological component that distorts perception. Investors would rather be wrong with the crowd than right alone. The consensus offers safety, or at least the feeling of it. When everyone agrees the market is strong, people stop questioning the underlying assumptions. They begin to mistake agreement for truth. But consensus is often the most dangerous place to stand because it means risk is no longer priced rationally, it's priced emotionally, and emotional pricing never ends well. The misunderstanding deepens when investors equate market movement with market health. Rising prices are interpreted as validation, but prices can rise in fragile environments. They can rise because liquidity is shallow, because sentiment is detached from reality, or because passive flows mechanically push indices higher. None of these scenarios indicate true strength. They only create the appearance of it. It's like judging a patient's health by the color of their face without checking their heartbeat. The symptoms look fine, while the underlying system is quietly failing. Investors don't know what we're in because they refuse to accept that the environment has changed. They want the old map to work in new terrain, and until they recognize the mismatch between the tools they're using and the conditions they're navigating, they will continue misreading the landscape. The danger isn't that investors are uninformed, it's that they're misinfo. Ahmed, guided by narratives that blind them to the signals that matter. The misunderstanding persists because it feels safer than the truth. But markets don't reward comfort. They reward clarity, and clarity begins with letting go of old assumptions before they become fatal. Market stability today is a performance, not a condition. What you see on the surface, the smooth price action, the confident commentary, the steady economic indicators, functions like a well-rehearsed play staged to keep investors comfortable. But behind the curtain, the structure holding everything together has been quietly weakening for years. It's the kind of deterioration that doesn't announce itself. It accumulates layer by layer, small enough to be ignored individually, but devastating in aggregate. Investors mistake silence for strength, stillness for stability, and that is always when the most damage occurs. What we're experiencing now is not resilience. It's a fragile equilibrium being mistaken for a durable foundation. The internal stress of this market comes from the simple fact that the environment changed faster than the system could adapt. When capital was nearly free, risk-taking became the default. LT behavior. Companies, consumers, and governments built their expectations, financial, operational, and psychological, around money that had no cost. That era ended abruptly. Rates rose, liquidity tightened, and leverage that once felt like a strategy became a liability, yet the market still behaves as if the old rules are in place. This mismatch creates invisible pressure. It's like tightening a bolt a quarter turn at a time. Nothing snaps immediately, but each turn adds strain, and eventually one more quarter turn becomes the one too many. What makes this market especially deceptive is that the cracks don't appear where people expect them. Investors look for obvious signs of weakness. Bank failures, corporate bankruptcies, panic selling. They want drama because drama is easy to identify and easy to blame. But markets rarely break through theatrics. They break through erosion. Liquidity dries up not in a sudden event, but through countless small decisions by participants choosing to step away. Credit weakens not when defaults spike, but when lending standards tighten quietly month after month. Consumer strength falters not when spending collapses, but when people spend the same ammo. By using twice as much credit. In isolation, each of these signs can be rationalized. Together, they reveal a structure under growing stress. Another reason investors misinterpret the stability is because modern markets have become incredibly good at masking fragility. Passive flows create the illusion of demand. Buybacks create the illusion of earnings strength. Financial engineering creates the illusion of profitability. Everything is optimized to appear stable, even when the fundamentals underneath are deteriorating. It's similar to watching a building with a fresh coat of paint and polished windows. From a distance, it looks immaculate. But if you put your hand on the support beam, you might feel it trembling. The market today has that same subtle vibration, the kind that signals something is off even if the visuals remain convincing. The great misunderstanding is that markets don't need a catastrophic shock to undergo major adjustment. They only need accumulated pressure to exceed the tolerance of the system. The break doesn't come when something dramatic happens. It comes when nothing dramatic happens and the deterioration simply reaches its threshold. Investors who look for an event miss the process. The process is already underway. Profit margins are rolling over. Balance sheets are weakening. Real income is stagnating. Debt burdens are rising. Liquidity is thinning. These are not sudden developments. They're the slow decay of conditions that once supported market strength. This illusion of stability becomes most dangerous when investors start treating it as proof of resilience. They believe the market has survived enough stress to be considered robust, but survival isn't resilience. Survival is simply the absence of immediate failure. A market can stay upright for a long time, even while its internal supports crumble. And when the final stressor arrives, no matter how trivial it looks in isolation, it reveals what was true all along: the stability was never real. It was a mask, worn by a system that has been weakening quietly, consistently, and inevitably. Investors often treat liquidity, diversification, and technology as foundational truths, but in this environment, they have become illusions that distort rather than clarify. Liquidity looks plentiful because prices move easily and markets appear active, but that's the kind of liquidity you only see when no one is under pressure. Real liquidity, the kind that absorbs stress without distorting prices, has been quietly thinning for years. The market functions normally only as long as everyone behaves normally. The moment participants hesitate, withdraw, or attempt to hedge simultaneously, the so-called liquidity evaporates. It's like walking on a frozen lake in early winter. The surface looks solid, smooth, perfectly capable of holding your weight. But beneath that surface is a thin, fragile layer that shatters the moment you rely on it. Investors today are dancing across that lake without realizing the ice has been warming from below. Diversification is falling victim to a similar misunderstanding. Investors convince themselves they are protected because they hold different sectors, different asset classes, and different geographies, but all of these exposures quietly depend on the same underlying driver: cheap capital. If the foundation of the entire investment landscape is the price of money, then spreading your portfolio across assets that all require low-cost money to justify their valuations isn't diversification. It's a collection of correlated vulnerabilities. It's lick. Filling a room with different kinds of furniture and convincing yourself the room is safe from a collapsing floor simply because the chairs, tables, and shelves aren't identical. When the floor gives out, everything falls together, no matter how varied the objects sitting on it. Modern portfolios have been built on that collapsing floor. The deeper issue is that correlations hide their true nature until stress arrives. In calm conditions, diversification looks effective. Assets move independently, volatility is low, and performance appears balanced. But those relationships change dramatically when fear enters the system. Correlations converge. That means the assets designed to hedge each other suddenly move in the same direction, eliminating the very protection investors thought they had. It's the financial equivalent of building several exits in a theater, but discovering they all lead to the same hallway when a fire breaks out. Investors assume that structural independence exists when in reality the connections only become visible during the crisis, when it's already too late. Technology adds another layer of distortion. The market has developed a habit of treating technology, cow promise, as a substitute for real financial metrics. Investors have become comfortable projecting future innovation forward as if it were guaranteed, frictionless, and immediate. They price breakthroughs years before those breakthroughs produce cash flows, or even prove themselves feasible at scale. Technology optimism becomes a valuation engine, and narratives become the currency of investment. But technology doesn't obey investor timelines. It moves in waves, often unpredictable, often slower than imagined, and always more expensive to implement than the early projections suggest. Markets, however, treat their early optimism as certainty. What makes this dangerous is not the technology itself, but the way investors use it as a justification for ignoring fundamental discipline. They assume high valuations are reasonable because the future will be extraordinary. They assume weak balance sheets don't matter because innovation will outpace financial fragility. They assume historical analogies are irrelevant because technology is rewriting the rules. But technology doesn't rewrite the rules of finance, it only changes the players. Cash flow still matters, costs still matter, competition still matters. Scalability still takes time. The misunderstanding lies in the belief that technology reduces risk when, in reality, it often increases it by inflating expectations beyond what the real economy can support. Investors lean on narratives of disruption instead of analyzing how those disruptions will translate into measurable returns. They conflate possibility with inevitability and treat hope as a valuation model. In this cycle, liquidity is thinner than it appears. Diversification is far less protective than investors assume, and technological optimism is priced as certainty instead of speculation. Together, these three illusions create a dangerous complacency. Investors believe they are more protected, more informed, and more forward-thinking than they actually are, and that misplaced confidence is exactly what leaves them most exposed when reality finally asserts itself. The idea that a market collapse must be sudden, dramatic, and violent blinds investors to the far more common and far more punishing reality: markets can decline slowly, quietly, and relentlessly in a way that drains conviction long before it drains capital. Investors have been trained to expect crises to arrive with sirens, spiking volatility, panic headlines, liquidations, and fear-driven capitulation. They imagine the next downturn as a replay of past shocks, as if the market always announces the moment when danger peaks. But the market doesn't owe anyone theatrics. More often, it unwinds in silence. The pain accumulates drip by drip, disguised as normal volatility, as routine corrections, as temporary softness in earnings, or as healthy consolidation. By the time investors recognize the pattern, the damage has already compounded. The slow, grinding revaluation is the type of decline people underestimate because it feels navigable at first. A few percentage points down, a modest earnings miss, a mild decline in consumer sentiment, none of it feels urgent. Investors rationalize each step. They point to familiar explanations, the same ones that make them comfortable. Seasonal weakness, profit-taking, macro noise. They tell themselves the long-term story is intact. And it might be, but long-term stories don't prevent long-term drawdowns. The danger in a grinding decline is not the magnitude of any individual step, but the cumulative effect of many small steps over an extended period. It's erosion, not collapse. And erosion is harder to detect because it is slow, patient, and steady. This type of revaluation emerges when expectations detach too far from fundamentals. Today's market is filled with inflated assumptions about earnings durability, consumer resilience, and technological acceleration. Those assumptions form the psychological ceiling that keeps valuations high. But ceilings don't shatter instantly. They sag, they crack. EY weaken. Companies begin guiding lower by subtle increments. Margins compress a few basis points at a time. Sales soften, not quarter over quarter, but year over year. Credit conditions tighten in ways only small businesses initially feel. Consumers shift from discretionary spending to necessity spending. None of this is catastrophic on its own, but the collective pattern is unmistakable. It signals that the structure supporting valuations is weakening from within. A grinding decline also manipulates investor psychology differently than a crash. Crashes evoke clarity. Fear is immediate, action is forced, and positions are liquidated because the shock demands it. In a slow decline, investors become trapped in a cycle of hesitation. Every small rebound convinces them the worst is over. Every mild rally reinforces the belief that the market has digested the news. They stay because leaving feels premature. They sell too little, too late, and with too much hope. The slow drip wears them down. Confidence doesn't break suddenly, it erodes. And once erosion becomes the dominant force, the recovery requires far more than a single catalyst. It requires sentiment, fundamentals, and liquidity to reset in unison, a rare alignment. This is why a grinding revaluation is more damaging than a sudden crash. It undermines the emotional and psychological resilience of investors. It reduces tolerance for volatility. It shrinks time horizons. It breeds second-guessing and forces decisions under fatigue rather than clarity. By the time investors finally accept that the cycle has changed, they are often too discouraged to act rationally. They miss opportunities not because they are blind, but because they are exhausted. We are in the early stages of an environment that supports exactly this kind of decline. Fundamentals are weakening in slow motion. Liquidity remains thin. Earnings expectations remain too high. And investors remain anchored to narratives that no longer reflect reality. The market doesn't need a crisis to correct. It only needs time. And time, right now, is not working in the investor's favor.